Okay, you're hearing me better now. I'm getting through, so I'll talk about it. Okay, that's good. Let's start. Can you close that? I'll close the poll now then. Right. Okay, there's no surprises then to see that most of the oil is produced in the Middle East, most of it being consumed by North America and the Asia Pacific. One important thing to note is the USA is also a big producer of oil, but none of its production ever leaves the USA, so they consume all that they produce and take more in as well. Maybe a little bit of irony is the fact that they spend a lot of money taking oil out of the ground and then they go and bury it back in the ground again as storage in the SPR, which stands for the Strategic Petroleum Reserves. This was set up in 1975 after the oil embargo to the US after the 1973-74 Yom Kippur War, where the USA was supplying oil to Israel. And they found out they didn't want to be in that situation again without a supply. So currently in the SPR we're looking at about 724 million barrels. And the capacity is 727 million barrels, so it's very nearly full at the moment. We've seen a couple of major events which has taken big draws out of the SPR in the past. Desert Storm and also the Hurricane Katrina. We saw draws on the SPR which obviously put prices up. USA is not the only country to have an SPR. Also we have Japan that has a capacity of 583 million barrels. And currently China is building their SPR and they hope to have a capacity of 685 million when it's ready. Okay, go to the next slide. Okay, so crude oil is traded globally in terms of barrels. It doesn't see the inside of a barrel anymore. The oil is pumped directly onto ships and then directly off through to the destination terminals. It goes through pipelines, and as it's going on and off the vessels, through the pipelines, it goes through a meter, which checks how much a barrels or equivalent of barrels is going through each time. To give you some idea on the vessels used, we use Panamaxes, so named because it's the largest vessel that can go through the Panama Canal. That takes about 500,000 barrels. Suezmax, so named because it's the largest vessel that can go through the Suez Canal, and that takes about 1 million barrels. And then we have the VLCC, very large crude containers. They can take approximately around 2 million barrels. Can't go to the next one. Okay, so now we're looking at how much it costs to get a barrel of oil out of the ground. Obviously you can see that traditionally the oil fields in the Middle East and Russia are the cheapest to get oil from, but they are finite, so people looking for where else we can find oil. So deep water, Canadian oil sands, these markets have been looked into, but obviously it costs a lot more to get the oil out from that basis. Next slide, please. Just wait for the slide to load up for everybody else. Okay, now I want to talk about Brent in particular, because Brent oil is the global benchmark crude. As I said before, WTI is domestic, so there's no point pricing the world's cruise against there because it never moves out from the US, but Brent does go around the world. The Brent blend itself is over 20 oil fields exporting from the Sullom Voe oil terminal in the Shetland Islands. Brent production itself is in decline, less than 220,000 barrels a day, but the Brent is a blend, and also included under that umbrella are other oils, Ekofisk, Forties and Oseberg, and they all can be deliverable under the Brent contract terms. Okay, as I said before, that Brent is the global benchmark for oil, so when we trade other crudes such as Kuwaiti, Dubai and Bonny, notice that some crudes are named after the country where they're from, others are from the fields, i.e. Bonny, and some are load ports. And just to give you an idea, if we were to trade the Q80, it trades on a diff or differential to the Brent. So the Brent for Q80 is, the diff for Q80 rather, is $6.25 roughly at the moment. So people will buy and sell at that number, but it all related to the flat price of the crude, in Brent crude. Okay, now we talk about the WTI, the West Texas Intermediate. This is basically, as I said before, the the US benchmark crude. It's deliverable at Cushing, Midlands. Most of the oil moves around the US in a big pipeline system. And it's what is the NYMEX light sweet crude contract is based on. Okay, before we move on, maybe we have a quick break here for any questions about the Brent or WTI physical crude, so the way physical crude is moved or stored. Do we have any questions? Right, okay, maybe we'll pause later on for some more questions. So now we talk about oil refining. You get a barrel of crude oil and you heat it up. What happens is, in a big picture of the distillery there, it breaks down to different components. As you can see, the bottom, the heavier or not so good quality produces as bitumen, is low at the bottom of the part, and at the top, the better quality fuels, the lighter fuels they're known as. That's where you get your LPG and other top quality stuff. What's interesting looking at this, you see that the picture of the car is above the aeroplane. Now, I for one used to think that the fuel that an aeroplane would fly on would be really good quality fuel, obviously better than what you put in your car. But that might be the case if the planes literally just flew from Europe to US and back. But the planes fly around the world, and some of the airports they go to, the fuel is of very poor quality, and therefore the plane wouldn't be able to fly unless it's adjusted to that poor quality fuel. So it's the lowest common denominator. It has to be low quality for all jets and all aeroplanes. So now look at the major products we get after distilling a barrel of crude oil. LPG, liquefied petroleum gas, that's used for heat generation and obviously vehicles. Gasoline is petrol, mainly. Kerosene and jet fuel, that's used for heat generation and obviously aircraft fuel. Gas oil and diesel, more or less the same product there. It's used for power generation. It's used for vehicles and also for heat generation. Fuel, power and heat generation is also used as shipping fuel. Then you have specialty products as naphtha, lube oils, waxes, bitumen and coke. The main difference between the major products and the specialty products is the major products are all burnt, and the use of it is by burning that fuel, whereas specialty products are used for lubrication and performing, making into plastics, etc., etc. They're not burnt in effect. Just to give you a rough idea of some of the yields we get from the different crudes, I've put a short graph up in here. WTI, as you see, the major product from there is fuel oil, but not as much as produced from Brent, but you get more naphtha out of WTI. So each refinery will fine-tune their refineries to actually get the best of that particular crude they have. Okay, we come on now to futures trading. Now, traditionally, the WTI was traded only on the NYMEX exchange in America, Brent crude oil was traded on the International Petroleum Exchange here in London. As times moved on, the pits closed down and electronic trading come in, we found that both exchanges now copy each other's contracts. So you can trade, as you can see, WTI on both now the CME and the ICE exchange. Same with Brent. There's no gas oil on the CME. Gas oil is still only a nice product, but they have heating oil, whereas the ICE doesn't. We found out as well, due to some of the credit risks we had with defaults such as Enron and TXU, that the OTC side of the market, where people relied on contracts between two different parties, was risky. So what the outcome from that is that these exchanges, they now clear OTC deals. So you can they're broked between two parties, but the counterparty risk is transferred to the exchange. So now we'll have a look at basically technical trading against fundamental trading. But yet again, before I start this, are there any questions? Okay then. Technical v fundamental trading. Dow Jones theory states that the market discounts all the news, meaning that fundamental news, yes, it affects the market, but that's reflected in the price. But I think every single oil trader I know who has technical analysis has always got one eye on the news. You can't tell me that the market's in a downtrend and they're trading it from the short side because it's discounting all the news, and then you have civil war in Libya, that you're not going to buy that in the news. It'll take a while to transfer into the market itself. So a lot of the news is now far more available than it was in the days of Mr. Dow trading. So it might take a couple of days for some information to get out to the general public. Now it's instantaneous with all the news services we have. The style of trading has also changed by the open outcry pit closures. A lot of the hedge funds wanted to come and trade on the crude contracts, but felt they couldn't do it through a pit trading system. And now that the exchanges have gone electronic, we've seen a lot of use from the hedge funds in, and they are very technical traders. So if a market's in a particular trend, you often see that the hedge funds support this. Like now, the market's very bullish with an uptrend at the moment, and there's big spec longs positions seen in the market. But these funds do provide a lot of liquidity to the market. They can exaggerate moves, as we saw in 2008, where the price reached a record high of 147.20, and then as those positions were unwound, it subsequently fell down to 33.20, and that happened in just a 6 month period. I don't really believe that the physical supply and demand picture changed that much as reflected by those price movement. So, looking at the oil events calendar, we have, we're looking for today is the release of the DOE figures. These come out weekly, every Wednesday at 10:30 New York time. Unless there's a public holiday, then they tend to be put forward to Thursday and also put back an extra half an hour so it doesn't clash with the natural gas figures, which is released at 10:30 on a Thursday. And what these figures show is a change from the previous week in the stocks of crude oil, WTI obviously, because they're from America, gasoline and distillates. Also have the API figures which come out, they come out last night, but these are largely ignored by the industry. They're just basically not so accurate. It was once put to me that a chap goes up on a helicopter, flies over the pads, has a look at them and just feels, you know, how much is in each one. It's all guesswork. I'm not sure that's exactly true, but the industry do not really look at these figures much. We do a daily report on oil, which we send out free to all customers. This goes out each morning, and on a Wednesday morning, you will see what the expectations for the DA figures will be for that day. Also, we have 2 monthly reports which the industry do keep their eye on. The International Energy Agency, IEA reports, and OPEC also produce a monthly report. It's a general overview of supplies, stocks, and also the expectations of demand from, the particular interest is sort of China, Japan, that area. And as you can see on this page here, these are the dates of the releases of these reports this year. I'd like to draw your attention to the economic calendar we have at the InterTrader website. By clicking this calendar here, you can actually get a download to a link through to that page. It's very useful, very easy to read, and you can see whenever the any oil news is pending. Another event which happens monthly on the oil event calendar is the non-farm payroll. Not directly a figure about oils at all, but it does have obviously a good influence on the dollar. Oil is priced to dollar, and sometimes it follows it very, very closely. Depends what other news is around in the markets. Sometimes it follows basically tick for tick. So if the euro-dollar is going to move, it will have effect on the price of oil. So that particular stats are watched closely by the industry. I'll just pass you over to Andy now. We're just going to talk briefly on the contracts that are available on the InterTrader MT4 platform.
Okay, so we have, as you can see from the slide, we have WTI and Brent, as Glenn's been saying, are the crude oil contracts. And on the InterTrader platform, you can trade in lot sizes, which exactly mirror the exchange, but you have the facility to trade in tenth of the lot sizes. So you can trade in 0.1 lots, which is 100 barrels instead of 1,000 barrels. This equates to obviously a tenth of the tick value on the exchange. So a move of 1 cent in the price of oil will equate to $10 on a full contract. If you're trading the small size, it's like $1 effect to your P&L for a 1 cent move. You can also see the gas oil on there, which is, as Glenn's made you aware, is a product of the other two. And you can also trade mini sizes on there. The standard tick size is 25 cents, which equates to $25 per tick, but you can also trade that in tenth sizes, which is equating to $2.50 a tick.
Do you answer that question?
Okay, yeah, I see there's a question here from Ryan regarding to the limits that were brought in. There was lots of talk of these limits when the market was going up, and the fear of these limits tended to have a pretty volatile effect on the market at the time, because everybody was worried that all the funds would have to bail out, and so we saw the market dip in and then being bought up again. But to be honest, now there's so many participants in the marketplace that the limits don't really have too much overall effect on where the price is going.
We can still see with the ranges and the movements we have in the markets now that those limits are not having an effect. There's far more players around than there were 5 years ago, so it's a different picture.
And then the beauty of these markets now, I'd like to add, is that like Shai kindly mentioned that we've both been in the markets for like 20 years or so, and but now as a retail investor, you can actually get a better service than I did when I first started trading. I used to have to call my broker, he'd shout into the pit trader would shout back to him. It might take me 30 seconds to get a feel on just a couple of lots of oil, whereas now all this can be done instantaneously at real market prices on better spreads than we used to have ourselves. So yeah, it's a real bonus to everybody that the electronic developments have allowed so many more users into the marketplace.
Okay, so I'll talk a little bit now about trading on the economic calendar events. As you know, in just over half an hour we're going to have the release of the DOE stats. We should see a movement in the market. We tend to every Wednesday. But one thing I want to stress is the relevant stat figures have on the price really does depend on what other news is around at the moment. I.e., if you first of all, I'd rather talk about the expectations of the figures and the perception of what the market's going to do. So if I put up on the slide there, if the market's expecting a large draw on the WTI crude stocks, we do get a draw, but it's half the size. You know, don't expect the market to rally. So you can't just be religious. There is a draw, it's going up. It doesn't work like that. It's the market's perception of those figures. We were expecting a larger draw than that. That would have been partly priced into the market, and you'd probably see it have a bearish effect, even though you're seeing a draw on stocks. So the perception is very, very important. Also, the stats themselves, yes, they will move the market, but how much the market will move, how much is paying attention to those stats depends on what else is happening in the world at the moment. As I put up on the slide, now you wouldn't sell Brent on bearish IE report if civil war has just kicked off in Saudi Arabia. You've got to look at what's happening in the big world and the relevance to what the stocks are going to do. It is very dramatic, that scenario, but you know, what we're seeing in the moment in Libya, it's not an impossibility. But also there's times, if we are following the dollar tick for tick, that's where the trader's focus will be on. So if the euro dollar was to move up, it wouldn't really have much effect on what the stats are. When markets are quiet, when the market's moving around on just basically what the weather is looking at, then you know there's not a lot of news around in the world, the stats would have a much more powerful importance. The chart on the slide now, if you've all got it, this is a 5-minute chart over the stats released last week. Now, as you can see, the market did move on those stats. The current news we have at the moment, which is mainly Japan, and it's obviously what's happening in the Middle East. The news is just as relevant as today as last week, so I'm expecting that when the figures are released today that we will have a reaction. Now, looking at the stats expectation for last week, it was interesting because we were expecting a build of 1.1 million for the crude, and we actually got a larger build of 1.8 million barrels per day, and the market went up. So why does that make sense? And the answer to that was because the products, we was expecting small draws in the gasoline and distillates, and we actually had much, much larger draws. So the way the market would have read that is there's demand for the products, therefore the refiners are going to switch that onto crude as well. You need the crude to make the product, so even though there was a build in crude stocks, the larger draws in products were perceived as more bullish for the market. So now I'd like to talk a little bit about the WTIBrent arbitrage. As Andy has said, we've been in the market for quite a while, and we worked a lot of this particular order. The customers like it. The arbitrage, what do we mean? You buy one contract in WTI and sell an equal and opposite contract in Brent, or more than one lot. It's traditionally been roughly around about a $2 premium of WTI over Brent. That that is because WTI is actually a better quality crude. It has a lower sulfur content. That's why it's known as a sweet crude. The more sulfur, the more sour the product. A lower sulfur crude will burn easier. It gives off less emissions and a lot more energy, so it's more desirable. But currently, we're seeing the arbitrage with Brent at a much higher premium, roughly about $10 at the moment. It was at a premium of $16. Why is the lower quality crude trading at a much premium to the better quality crude? The answer is basically supply and demand. WTI has a lot of storage in Cushing. It's pipelines, new pipelines coming in from Canada. There's lots of oil around there. There's not much demand for it. As I've mentioned earlier, Brent is a global crude. It's benchmarked for the rest of the world. So all the troubles we're seeing in the Middle East will all be reflected in the Brent contract. That's just taking that higher. Here's a graph. As you can see on the left, we have TI, that $2 premium over Brent, and then you can see the big breakaway of Brent above TI at the moment. The industry have always been trading Brent, WTI arb, for as long as I've been involved in oil. But now other speculators and hedge funds are looking at this as well. It's a new product for them. It's traded itself as a product.
And on the, I'd just like to add on your InterTrader platform, the contracts roll at exactly the same time, so you're always comparing the same Brent with WTI, so you can trade exactly the same arb all the time and be involved in that market.
I often get asked the question, with the premium at $10–15 of Brent over WTI, why do people not ship cargoes of WTI over to Europe? It's never been done before. The main reason why is it's a deliverable contract into the Cushing area, which is a very difficult place. It's up a little river, and it's just physically very, very difficult for people to get the vessels in to take delivery. And once they do get it back to Europe, even though it's a better quality crude oil, the refineries are quite finely tuned for the crude that they get. So they always like to try and get the same crude consistently in. So if they get a supply from Russia, it's geared up to burn that particular crude oil. If it suddenly takes WTI, and it's a lot of alterations they need to do to the refinery itself. So this is why you're not seeing the arb collapse back as people are shipping it over. It stays domestically in the US. This slide here I've already covered earlier on. It's explaining why we're seeing the high premium of Brent over WTI. For a more physical point of view, the crack, the gas oil to Brent crack as it's known, has been traded by the industry, as I say, for a long time, like the arb. It's called the crack because the gas oil, or the Brent rather, goes through a cracking unit which they get the gas oil from, so that's where the name arrives from. It's the same, you would buy Brent and sell gas oil, opposite positions, but because gas oil is traded in dollars per tonne and Brent is traded in barrels per tonne, you would actually do a ratio of 4 to 3, 4 lots of gas oil to 3 lots of Brent. That's what the industry would do, but as the price moves, the speculators will just do a 1-to-1 contract crack position for that. So traditionally, refiners, they need crude oil, so they have to buy it, so they're naturally going to be long of crude, and the products, they need to sell it, so they naturally need to be hedged short of that. So this is why the crack has been trading. But it's speculators are also taking positions on the crack. What would affect it? It's supply and demand again. To give you an example, look what happened in Japan after the earthquake and tsunami out there. the refineries are shut down, they're not working at the moment, so there's no demand for crude oil. So that will be a bearish effect on the crude, but they need the product. They need to ship in some of the gasoline, gas oil, heating oil. So there's demand for the products. So there a way you would see the crack widening, and in fact the crack did widen on that news. So it's good to take positions and look at the different supply and demands around. Just gives you another trading tool there. Here we can see an example of how much the crack trades. For this chart, I've taken the gas oil price and I've converted it to dollars a barrel, so you can see the price related to the Brent price. Obviously, you would always see gas oil as a premium. You never see Brent over the price of gas oil, or else the refiners would go out of business if the product they need to buy is more expensive than the product they produce. We Andy and I were the first people to put oil onto the MetaTrader 4 trading platform, and we were calling around a lot of people to get them to be aware of the products there, and we wanted to give it a little advert. So we did a study and we looked at the volatility of the WTI and the Brent crude oil markets to all the currency pairs, and it's no surprise to see that oil is a very volatile contract. It gives you lots of trading opportunities, which is good for the investor. But in addition to the risk warning, please protect yourself against adverse price movements. Do not trade with any more money than you can afford to lose. Very prudent to put stop losses in whenever you put a position on, so you can exit a losing trade and still have some money to trade again another day. But very volatile contracts, I'm sure you're all aware. The InterTrader MetaTrader 4 team, we've said it before, we've got a lot of experience in trading and broking oil futures, swaps and options as well. We still keep in contact with all our friends that we have in the oil industry, and that's information that we can pass on through, and we're happy to take calls, we're happy for people to email us, we're here to service people. Fully trained in technical analysis. I'm a member of the STA, the Society for Technical Analysts, and did a diploma with them. Well, we can't recommend trading strategies for you. We can't say buy here, sell there, but we can give you the news on what's affecting the market at the moment, any technical points of where the trends are, and this information could prove invaluable for your trading. At the end of the slide, or at the end of the show, I'll announce phone numbers where you can contact us on, and email addresses. Alright, before I go to the summary, could we ask if people have any questions, please? Can we type? In fact, I'm going to type up on the general chat the phone numbers +44 680 and our email addresses. Yeah. I have a question here. Do we ever trade a WTI Brent spread, the ARB? Well, we are not traders ourselves. A lot of our customers do trade that ARB. You can see there, there's the phone number that you can call us on anytime. And just type up the email address. G.org.
Okay, but what we've seen with a lot of people on the WTI Brent spread is when it went to about $4 or $5, because it had been people were used to it being trading at 2, like Glenn mentioned earlier. Then they think that they're getting a good thing at 4, and then it very, very quickly shot up to 5, 6, 7, 8, 9, 10. So and then what often happens in the market is people will think that they're getting a good opportunity, and then there's more and more sellers come in, the market moves some more, and these people have to stop themselves out. So what's happened is the market's just kept going up and up and up, exacerbated by people's getting out of their short positions. We're just putting up the expectations for today's figures that are going to be released. It's often a case of not the figures themselves that cause the market to move, but it's the discrepancy from what is expected. So we'll keep a close eye on this and see where they come in. If they come in pretty much in line, and as with any market, then we expect it to have very, very little effect. But it's pretty rare that you get all 3 sets of figures coming in line with expectations.
These numbers are basically derived by Dow Jones, the news agency, would contact a list of 12 oil traders and ask them what they predict. So it's not particularly accurate, but it does give you a rough idea. Also, they are in a way priced in the market already. If we had seen particular expectations of large build in crudes and large build in the stocks as well, the market would have already had a downward reaction to those. So in a way it's priced in, and that's why you can get large draws, the market's still going higher. As I said, it's all about perception. If it's not draws, market should go higher, but sometimes it does the opposite because the numbers don't reach the expected numbers. Today, they're not big. These are sort of average sort of expectations. So,
and these numbers are in millions.
Millions
of barrels, yeah, or barrels equivalent. So I think Paul, you're saying that you mean deviation. If you mean deviation from number, what would be a big deviation from those numbers? You'd be looking, if any of them are like say 2 million different from what's expected, that would be a reasonably big deviation from what's expected. So if we see crude come in at -5 or something, then that would be a hugely bullish number for crude. Okay, yeah, and Frederick, yeah, the Brent price is so high because there is an oversupply of the WTI contracts in the US. They're experiencing very, very high stocks, and that doesn't, no one's expecting that to change very quickly. Also, the problems that we're seeing in the MENA areas, the Middle East, North Africa, are causing geopolitical risk, and there's more risk to the Brent contract because that's the one that gets shipped around rather than the WTI, which tends to stay in the US. So you're seeing a geopolitical premium in the Brent contracts more so than you are in the WTI.
And that's the same answer for you, really, Charlie.
It is best to find a clear trading strategy. It's like I mentioned before, we're seeing people selling it at 4 and 5 thinking it was a really good thing to do. But what you really must do is you need to accept when you've got something wrong. Okay, it does look like a great trade at 4, but it's not such a great trade when it's gone to 6 and you've lost 200 points on the trade. So you need to know where your stop out levels are, and you need to just be aware to say when you're wrong. Yeah, it's because it's always the losing trades that cost you more. The ones that you stay in for too long are the ones that hurt you the most.
Also, markets do change, the world does change. I explained earlier that the electronic trading system, that helped bring the funds in, which brings a lot more liquidity to the market. So just because, over the past 10 years, you might have seen WTI a $1 or $2 or $3 premium to Brent, and only dipping under Brent when there's particularly news out that affects the supply demand and those for a short period and it goes back, doesn't mean to say that it's going to go back there again now. There's, as Annie mentioned, good storage in the Cushing area, and there's new pipelines being built from Canada and the process we're doing now. So a lot of this is what we're saying about perception again. That actual storage isn't there now. They're building more storage, they're building more pipelines. So the world has changed. So don't expect it to go back again. Obviously, you had people selling into the ARB all on the way up there because it hadn't done this before, and they thought it would go back to normal. And that's what feeds it. When it was 16, like who was buying it at 16? It was the people who were short it at 8 that had no choice but to buy it back then. That's what you see on market highs and lows. Why do people buy the market highs? Well, who bought it $127.50 back in July 2008? Why was someone buying that high? And the answer to that is they had no choice. They ran out of money. So it forces them out.
And you're saying, Charles, again, to trade the spread and trade breakouts on the spread. With the ARB, it's quite a hard thing to do because at the moment there's no real range on this thing. It's just been like moving up and then down a little bit. But you're quite right. When it was like trading around $2 and it moves out to $3, the sensible thing is often to go with the move, because it's something that you can't quantify, but it's moving for a reason. And go with the move rather than against it is often the best way.
Okay, we have just under 10 minutes now until the DOEs come out, so I'm going to move to the last summary, and then we're going to go to look at the MetaTrader platform to look at the actual live charts. So just to summarise, oil markets, they're a fantastic tool to trade due to their volatility, giving you plenty of opportunities for market movement. It's not often that crude sits there going sideways. The markets react to news that is available to everyone. No one's got any inside information. The big events move oil, and the big events are all over, all news. The way oil's traded gives you, in different regions, the opportunities to trade on the ARB, the WTIBrent ARB. If something's happening in the Middle East, it will affect Brent more than WTI because all the oil in the Middle East is priced against Brent. To summarise the difference in products, the example I used earlier in Japan, that's going to affect the crack price. No point getting Brent in there because they can't refine it at the moment, their refineries aren't working, but they need the products. So that affects the crack. All of this you can trade on the InterTrader MT4 platform, which we will now call up. Change that to the right one. So here we are. This is a 5-minute chart, so we could be able to see the moves quite well when the stats come out. Overall, oil is in an uptrend. We're seeing higher highs, we're seeing higher lows. The price is up above the moving averages. Moving averages have crossed each other to the upside. They're all pointed higher, which is bullish indicators. So, yes, the market's looking nice, strong uptrend. So, any dips tend to be bought by the speculators, which you expect in an uptrend. But one word of caution is there's a very large, long speculative interest in oil. So if peace was to break out, if any other bearish news were to come along, there's a lot of just change the chart over to daily, just to reiterate what I'm talking about now. there we are. We can see that nice uptrend all the way from April. It did have a correction, and that dip, as you see, was sharply bought going back a few weeks. So bear in mind there's a very large spec position at the moment in the WTI and the Brent contracts. So any bearish news, you could have an exaggerated move to the downside as these positions are liquidated. Now, I believe that will only be a short thing anyway, because I don't think the unrest we're seeing in the Middle East is going to go away too quickly. And oil, like gold, is now sort of seen as an asset by the funds. So whenever there's a good pullback in oil, people want to own oil in their inventories. So people do like to buy on dips anyway. But I like my old Dow theory and massive bull trend, and it shows no sign of reversing.
But yeah, while we're on this, I mean, it's a slightly different subject rather than the chart itself. But yeah, you're seeing a lot of these commodities are becoming asset classes in their own right now in terms of how the funds look at them. You know, in the past we've had interest rates 5-6%. You know, so people are looking more for financial instruments. But when you're seeing a really low interest rate environment, why hold bonds that are going to give you really low yields when you can invest in different asset classes which are being used in their own right as asset classes and as good hedges against inflation? But Charles, you were saying the questions about moving out of ranges. And if you look back to December, there the market was in a pretty good range, and then as soon as we see it breaking through like towards the mid-90s, then you're seeing it move into a new area. So that's often the good thing to do. But be very careful, because it could quite easily fall back in. But using correct stops then to protect yourselves, then you should be always be aware of that.
I'm going to change the chart back to the following video. Yeah.
I'll just change the chart back to a 5-minute chart now ahead of the stats, so we can gauge a better idea of the size of the moves that we're going to be getting.
I'm going to put a call through in a couple of minutes to our desk so we can actually find out what the stats are, so we can announce them to you as they come out. Often the market moved just before the stats as well. Some people think it's other people hearing the news before them. They're very religiously come out exactly at past, and they are very well guarded. So there's no truth in that. What you see is just people putting on positions for them. They might have their own guess and want to see what's going on, and that's why sometimes you see the market move around before they come out. Often people think, oh, someone knows that they're bullish, and they'll just start buy just because the market's going up, and it starts a little chain reaction with stops being triggered, etc., only to find out the stats come out bearish and it all turns around again. So that's why you see movement over the figures. As with any news release, what a market tends to do is overreact. So as the news comes out, bullish figures maybe, you see the market rally up. It doesn't usually just keep going in a straight line up. It has its reaction, and then it has a little counter reaction to that as well, which is a trading opportunity in itself. I'm sure the wise traders are using that. So just a few minutes to go now. Market still on the day, it's been strong. We've seen a little bit of movement here around the 105.47 level. Obviously, 590 in the daytime here.
Yes, just short of 106 on the day has been the high.
106 is a nice round figure, so if it does shoot up, we would expect to see some resistance around the 106 level. You talk just quickly.
Yeah, we're just obviously we're just waiting here, so we've got nothing planned to speak about. We're just putting the calls through to the desk to make sure that we get the figures as they're coming through. But it is a case of you know, it's how the market reacts to figures that is the important thing, not the figures themselves. Back in 2008, I remember gasoline was roaring away, and we saw probably the most bullish gasoline figures ever, and the market only went up a little bit. And I was watching this thinking, why is it only going up a little bit on those figures? And basically it's because everybody was long, and then we saw a huge collapse on the back of really bullish figures. So it's a case of you have to be able to watch how the market reacts a lot of the time rather than what the figures themselves are or appear to be.
But I want you to tell us what the stats are when they come out. You've got them ready on the chart. Okay. I won't keep talking. But
so we have about 2 minutes now before the figures come out.
So just to reiterate, I mean, comparing this to last week, we had roughly the same news going on as last week. The market did react to them, so I would expect, unless they're just as expected, boring figures, I would expect we would have some movement today. An hour into the last minute. Yeah, yes, I will. Sorry for the pause, just waiting for them to be announced.
Okay, so I'll just run over what the expectations are again. We're expecting a build of 1.7, which is an increase in stock of 1.7 on the crude, a 1.4 draw, which is a drop in distillate stocks, and a drop of 2 on the gasoline stocks. So in other words, a build in the crude and a draw in products, we would term that as an expectation in the industry. We're still hovering around the 105.5 mark.
Build of 2.13 crude.
Okay, we're having a build. We're seeing a build on crude of 2.13, which is in line.
What's it, sorry? A draw of 5.32 on gasoline.
Right, a draw of 5.32 on gasoline, which is a very bullish number.
Okay, unchanged in distance.
And unchanged in distillates. So we're seeing a little bit of a mixed bag there. We're seeing a much bigger draw than expected on gasoline, but we're not seeing a draw at all in distillates, which is a bearish factor. And the crude is a slight increase, which is slightly bearish as well. So overall, the bearish and bullish seem to be
counteracting each other. I think people are uncertain how to interpret this, how the market's going to interpret this. That's why we're not seeing much of a movement today. A larger than expected draw in crude, offset by a larger than expected draw in gasoline. But as it is the crude market, it's been difficult for the traders to what to make of it. So I think they're just basically leaving it low. And as you can see here, we're at the same numbers as we were just before the release. So very sorry to do the webinar on a boring day for the stats. It does happen sometimes. Do you want to go back so that we can see the questions?
We're going to go back to the slides now, and we're happy to take any more questions, please.
Okay, there's a question from Alexandra who's saying, don't leaders of countries like Libya or Saudi Arabia have an edge?
Well, I guess they do, but to be honest, if you're a leader of Saudi Arabia, the most important thing that you need to do, the world needs to know that you're genuine in what you're trying to achieve. So if you're trying to make a little bit of money for yourself ahead of your country's interests, then that just wouldn't make sense for someone in such a high position to be doing something like that. He'd rather make the money for his country out of the oil price rather than make a couple of million by trading some futures.
I think having a reliable contract which is honest and trusted by everyone is a benefit for everyone. If it was abused in any way, then it wouldn't work as its role as a sort of benchmark and a pricing module and a tool for people to hedge on. So these leaders, they understand this and they're not going to abuse it, or they should not abuse it. But there again, you know, they might find they have some information from their own country which would affect the price, and it might be offset to use somewhere else. They might end up losing anyway.
Yeah, we are always reviewing contracts and what we can do for customers. So Paul, in terms of 10 pence a point, that's not anything that we can agree on here at all. Everything is set up as a 0.1 minimum, which is pretty much $1 a point. So you're still looking at less than a pound. But yeah, that's one for like marketing and for other people to look at. We're really restricted with the contract sizes we have at the moment.
Are there any other questions?
I'll see, does he want to... What about the emails? There's just some details on the website.